You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
You know, I read an article, I think it was in the Wall Street Journal, about how a lot of seniors now are getting robotic pets to keep them company. And you're watching Tom during the break. Honest to God, he's so energetic when the internet's working that I'm starting to wonder whether he's real or robotic.
Thank you. I'll take that.
You get
a faint praise in some way, but
you
get
all wired up when the wiring's working. It's just
everything's working. It's so exciting.
Hey, folks, welcome to Talking Real Money. I'm Don. That's Tom. You're there. Thank you for being there. We appreciate you. We want to help you understand money. We want to help you understand investing, particularly because, are there a lot of people who would like to mislead you? Holy mackerel, they're everywhere. They really are. In fact, just the other day, Tom turned on his TV and went, "Oh, not them!" Yeah,
they're out there because the
guys
sell that lovely product that makes them so much money and is the bond alternative, Don, or the CD alternative, or the fixed income alternative that will make you more than the market, but just as safe.
Well, it's funny you should mention that. Let me just give out the phone number, because before we do anything else, I would like to address that. We actually got a question just during the top of the hour about that and I thought it would satisfy you to be able to say something
Take
about
a lot.
it. Yeah. So give us a call, 855-935-TALK, or apparently a lot of you now are getting the hang of sending in questions at talkingrealmoney.com on the contact form. And so either way, 855-935-TALK or go to talkingrealmoney.com.
Let's make this the best hour ever.
Let's do that. Well, and this is going to be, this is the way to start it. Not with any of this other stuff, but with this. Because the subject, coincidentally, is EIA/FIA, use in retirement to protect principal with possibility of upside growth. The question is, what do you think of using EIA, equity indexed annuity, I'm going to translate for you, /FIA, fixed indexed annuities, parentheses, 7 to 10 years, with a 0% spread, 90 to 100% participation rate, and no cap? Well, first, those three things make me very suspicious. I'll explain those.
I think
in a
you need
minute.
to go back and
explain those.
Equity index annuity is.
After I finish this. To protect principal associated with retirement income stream with potential for upside growth. This has been proposed, and I know by whom, as an alternative to CDs, or I'm pretty sure I know by whom, because they're huge and they're proposing them to everyone. And they say they're fiduciaries, you liars. Bond and income funds that will suffer in this zero interest environment with only increasing interest rates in the future.
Oh. Interest rates have to go up. You're going to make nothing on bonds.
Okay, maybe. It's possible. Yeah. It is. It is. But selling them as an alternative to CDs or bonds is one of the most disingenuous things I've ever heard. And that's exactly what these people are doing. And it is, in fact, a prevarication.
I think that's a very good word for this, Don.
Yeah. Okay. An equity indexed annuity is a very, very complex annuity contract. Extremely complex. It gives you a return based on a portion of an index's return, but most of the time these days, they're really eclectic, weird indexes that nobody can follow anywhere, anytime. And it's sometimes a point to point, like over this period, like from this day to this day, you get the return of the market minus this. And that's where I'm really skeptical of this one, because usually there's a spread Like you only get and the participation rate, you only get a portion of the return of the index. Like if the S&P 500 went up 10%, you'd only get 8%, something like that. No cap. Usually they'll cap it. They'll say 8 is the max, something like that. They're saying there's no cap, which leads me to believe they're using a very esoteric index that they have calculated carefully will not provide you a return greater than maybe 3% per year, because they cannot afford to give you more than 3% per year in this environment. And that's only in the good
by
years.
The way, yeah, so let's just go back a little bit on this, because this is a product that's been around for, maybe 10 years?
Or longer. We're just getting old.
Okay, yeah. And there's only been a couple of times I've really seen these pulled apart.
I did
where
one. I wrote a really long
I was going to give you full credit,
yeah.
and it's up. It's probably online somewhere. We could go.
It's at Real Investing Journal.
Yeah, you went out and you looked at the actual way the money's invested and what you should make on them. Then there was another article that talked about what you actually made on these over the long haul that was written a couple of years ago. We'll come back. We'll talk a little more about those.
Yeah,
and
because
why you want to complicate your life this way.
These
That makes sense to me.
And why they sell them so vociferously, you'll really be interested in knowing.
Are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
For your real life and real future, Tom and Don are talking real money.
855-935-8255. Call us. Du-du-du. It's my little jingle. Hi, I'm Jingle Don. Jingle all the way. And that's...
Yeah, Christmas is only, 45 shopping days away or something, right?
It's ridiculously close.
Yeah.
It's like election Christmas.
Yeah, we've already spent enough time talking about. Don't go out and trade based on who you think's going to win or lose or whatever. That's 25 trading days. It's silly. Don't do it, please.
No, just vote.
Yeah.
855-935-TALK. That's our number. Anyway, we're talking about equity indexed annuities. Equity indexed annuities. I wish they didn't exist. There's a long and checkered past to equity indexed annuities. When they first came out, the Securities and Exchange Commission wanted to regulate them as investments because they're sold as investments. They are. They're not sold as insurance. They're sold as investments. The insurance industry spent tens of millions of dollars lobbying to keep the control of these with the state insurance regulators, who are terrible regulators in many parts of the country. They let these people get away with murder. An EIA, FIA, an equity indexed annuity, fixed indexed annuity, is a sold product. I, honest to goodness, have never spoken with anyone who went out and went, I gotta get me an equity indexed annuity today.
It's that or the new Tesla. I guess I'll go with the equity index.
No, I'm going for the Tesla. It's a better deal.
Okay.
Because guess what? Let's say, I don't know, after the first year you go, well, that return stunk. I want my money back. No.
Well, you can't get it. I mean, as we mentioned, there's only been two places I've really seen. You did a very nice article about how they really work, what you really make. And then there was another article, I think it was in one of the major publications a couple of years ago, that said, looking back over the last, I think it was like 10 years, they've averaged return of about 3%.
At the time, it was 3 to 4%, but that's when rates were 3 to 4%. You're probably not even going to get that these days. But they're not going to, the guarantees of rates have vanished because there is no way to guarantee rates anymore. And the commissions remain ridiculous. And they lie about commissions. Trust me, I've been to the steak dinners and ask the question. They lie about the commissions. The commissions range from 7 to 10% of the money you put in, which is why if you want to get your money out, it's going to cost you 10% the first year to get out.
Yeah, this is a product, as you said, that is sold. This is not a product that's really needed.
No, except to make insurance salespeople rich.
So,
yeah, do not buy an equity indexed annuity. period. Do not buy an equity indexed annuity. There's only one academic who kind of sort of supports him a little bit, and that's only because he gets paid by the insurance industry. That's Wade
I wish
Pfau.
he didn't too. Yeah,
he does. His school of business is like the Northwestern Mutual School of Business or something. I don't remember that's the exact name. I may be wrong. I'm just saying. Anyway, so don't go get those. Thank you. 855-935-TALK is the number. Yeah. Joel, you are up next. Welcome to Talking Real Money.
I've been listening to you guys for years. I have gone to a couple of your seminars and had a blueprint done years back. I'm getting close to retirement, and probably will pull all the money out of the 401k and need to move it to Vanguard. I need to know how to put it, and as it stands right now, I have the Vanguard total bond market, total international stock, and total stock market, which you guys recommended, 4 or 5 years back.
Yeah, we like those.
Do I take the 401k money and dump it in the same funds? And if so, what percentage splits should I be doing?
Well, we can answer the first question. Yeah. That's easy. Sure, why not? The split, that gets harder because that's an individualized thing.
Yeah, what we're really talking about there, Joel, is the first measure would be how much of your money do you want to have in stocks and how much of your money do you want to have in bonds?
And that is really determined by needs and
20% the international and the remaining 40% in the total stock market index.
So you're 60-40, but overweighted to the U.S.
I'm a little afraid of currency fluctuations for the international.
Why? Yeah.
Why?
I just, I've heard some real horror stories about being in certain markets and have the conversion back to dollars a little bad.
Then somebody's making stuff up because
it just hasn't happened.
It hasn't happened.
Okay.
It's never happened, ever. Currencies tend to fluctuate within a very, very narrow range against each other, particularly when you're talking about the big three, the pound, the euro, and the dollar. They fluctuate within a very, very narrow range. The yuan is tightly controlled by the Chinese government. The yen doesn't fluctuate particularly wildly. One will prevail for a little while, then the other will prevail for a little while. They move back and forth, but it isn't dramatic. It's not like owning Bitcoin where you get 100% fluctuations. That is a spurious argument. It really, really is.
You could have made a much more effective argument saying the U.S. market has performed much better over the last 10 years,
which it has.
We could suffer through that argument. But no, you should be balanced between the U.S. and international.
I'm about a year and a half of retiring, and I'm looking at pulling the 401k money and pouring it into the Vanguard stuff, and just wanted to make sure I was putting it in the right funds.
Well, here's what I want you to do, though.
Them around a bunch.
If you haven't done it, go take the risk quiz. Because what you have it in is more dependent upon your ability to tolerate volatility than there being any correct allocation per se.
True.
If you're 60 U.S. and 40 international, that's pretty darn close.
No, 40 U.S., 20 international.
Right. I'm just saying, if you get to that kind of a thing, you're close. At 40-20, which is a 60-30, you're still off a little bit. I think you should have a little more international, but if it's going to make you uncomfortable, we don't really care that much. But the more important allocation is your stock-bond ratio, because that's what determines the level of overall portfolio volatility.
But I'm going to argue with Don just a little bit there, because if I was going to build a portfolio today, if you're buying international, you're buying the underperformer for the last 10 years. It always, if you look back,
I agree with you.
It's always made sense to buy things that haven't done as well as others. Do you want to buy the 5 stocks that now have gone up 49% this year where everything else really hasn't? Or do you want to buy the rest of the stuff? I'm going to buy the rest of the stuff. That just makes sense. Really, it's intuitive. And yet people think, no, I'm going to put it all in the FAMA stocks. That's
and we forget. We tend to forget that from 2000 to 2010, the S&P 500 was horrible, and the internationals bailed you out. So There you go. Thanks
Joel?
for the call.
And thank you, Joel, for listening and for coming to our classes. Everything. That's very kind of him.
Yeah.
Thank you.
Yeah. Give us a call, 855-935-8255. This is so much better an hour. Everything feels better. Thank you all. Thank you for hanging in with us. We'll be back, though. 855-935-TALK. Give us a call or go to TalkingRealMoney.com and send questions in.
Tom and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And you know you need help. Give us a call at 855-935-TALK, 855-935-8255. I'm Don. That's Tom.
And you know, when you have home country bias, it exists everywhere. If you go to Germany, it's about 85% of the money that people invest. They invest in German stocks. You go to Great Britain, it's somewhere around 80. People have a home. They just believe in it more. I know those companies. I know the way the things work, et cetera, et cetera. But let's just imagine for a moment that you are of Japanese descent. You are in Japan.
You're a Japanese citizen. You live there.
Japanese citizen. Thank you. Mm-hmm. And guess what? Your markets have just been going crazy. Your economy has been going crazy. You are so successful as business people that now your business, the way you operate, has now been exported to the largest country in the world called the United States of America.
As a matter of fact, at the time we were going, we need to be more like Japan.
Yeah, your management systems, and you're buying up huge things in the United States, golf course, all this stuff. It's all about Japan. Those of you old enough to remember 1990 can certainly remember this, right? Right. Where would you put all your money in 1990? Oh, in Japan. And now, 30 years later, how's that done? Well, it's actually still underwater.
Yeah.
Underwater, 30 years. So I'm not saying that's going to happen in the United States, but I'm saying it could. Wouldn't you rather spread it around so you have more exposure to other countries that may have better stock markets in the next 20 years? That's all I'm saying. So if you think you're so smart, it's all about the U.S., boy, everybody in Japan was sure it was all about Japan 30 years ago. I guarantee it. And they have paid a huge price.
Diversification has bailed investors out over and over and over again. Do not even begin to think you're smarter than the market. 855-935-TALK. Walt, you're up. Welcome to Talking Real Money.
Hey, thanks for having me. I've got about $500,000 sitting in a savings account right now. I'm talked to a few investors or advisors, and it seems like they want a lot of money to play with my money, and I'm wondering how I should go about or what I should be looking for.
Wait a minute.
Well, first of all, no advisor should play with your money.
Yeah.
But,
what do they? What do you mean they want a lot of money? Their fees are high.
How much is high?
I think so. One was a 1.25%, 1.25%, and they take it out 4 times a year. Another one was 1.36%.
Mm-hmm. All right, now that's little on the high side. I agree. That's a little on the high side. There are some that are as high as 3, though. So it's not awful. Could be worse. But here's my question: where did that $500,000 come from?
I'm an attorney, self-employed, and I've been saving it.
Okay, so this isn't money you pulled out of the market in March or anything.
No. This is my wife works for an international oil company, so her money, they have advisors take care of hers as part of her employment. And being self-employed, I don't have that luxury, so I'm looking for where I should put it, what I should do.
Well, let me ask you another question. I mean, you're obviously an educated person. Are you able to manage this on your own?
Or do you need somebody?
I think I'm good at what I do. I don't know if I'm good at. I don't have the expertise to go in there.
He is an educated person. See,
yeah, that's smart
the answer an educated, smart person would give you.
Exactly.
I don't know what I don't know. There you go.
So what do we think? We think 1%. You shouldn't pay more than 1.
Max.
Yeah.
That is the max.
And you can find those, and we're not the only people, but we are less than 1. And you can certainly go to our website for a list of those.
Yeah, here's what I'd suggest you do. We actually, you ever watch the movie Miracle on 34th Street?
Oh, of course.
Every Christmas.
Yeah. Well, you know how Santa says, we don't have that at Macy's, go to Gimbel's?
Right.
Well, we actually decided to make a list of Seattle area Gimbels. Because we're a Macy's, but Macy's isn't always the best. It's out of business. So go to
department store still around.
Go to talkingrealmoney.com/help. And we actually put together a list of Seattle area advisors that we believe follow the science of investing.
And we charge 0.9% at the highest level. So we'd be a little less than that. Those deals are out there. You could find people less expensive than us too.
Yeah, hard, but yeah, maybe. Robos mainly, though. 855-935-TALK's our number. Thanks for the call, Walt. Be right back.
Talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics. That's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Reality radio for a really great future. We're talking real money.
Hey there, welcome back to the program. I'm Don, that's Tom, 855-935-TALK. That's our phone number. We would love to help you muddle through your financial life a little better than before, a lot less complicated than before. 855-935-TALK. You can call that number 24/7. And Michael, it's your turn. Welcome to Talking Real Money.
Hi, guys. I have a question about RMDs. And,
okay, this is for Tom. Tom, RMDs, it's all for you. Go
ahead.
Yeah, my question is, first of all, can you confirm that I'm not required to take an RMD in this current year?
Yes, I can confirm that.
Okay.
He is a robot.
Here's the question. I'm retiring at the end of this month, real soon, and if I don't begin taking my retirement and I get a part-time job, even say if it's like 15 or 20 hours a week, would that exempt me from taking RMD next year?
Only if you're working for the same company.
Only if you're working. Okay. So it wouldn't be the same company.
Yeah, the required. I mean, there's an easy way. There's an easy way to the reason why, right? A required minimum distribution is what the government wants you to take out of the money that you saved pre-tax, and add the growth of hopefully how you had it invested. Take it out and pay tax because you haven't paid any tax on that money. So they're like, you got to pay us something on that. You got the 1 year reprieve this year because of the CARES Act or what I always
CARES Act. Yeah, I think it was CARES Act. Yeah.
And they've last year they pushed it back to age 72, so you don't have to start at 70 and a half, 72. But they're going to want their money at some point, so they're saying and by the way, it's another reason I think young people really should think hard about mainly doing Roth 401k because you get all those years of tax-free growth. It's such a great deal. But yes, in your case, Michael, you don't have to do anything this year. But once you hit 72, unless you're still working at that company and in that plan, you got to start taking the money out.
Okay, gotcha. All right. Thanks, guys. Great
Thanks
show. Wish you were on a few more hours. It's kind of short.
Well, we do
we'll stay on.
We do podcasts too. Check them out. We do a podcast every day. TalkingRealMoney.com. TalkingRealMoney.com or on any podcast service.
Including Amazon.
Including Amazon now, yeah. So check it out. There are only about 400 and some odd podcasts to get you caught up. So,
Michael, become one of those that have heard every podcast.
Every show.
Because there's like 2 or 3 people that have actually. Anyway, thank you for listening. And yes.
Yeah, Michael's
every day.
a great example of what you just said. The reason why good savers, people who are good savers and good investors, really ought to start thinking about putting more money in Roth accounts, even though they don't get an immediate tax deduction, because it turns out that good savers get into retirement and they go, well, I don't want to pay all these taxes now.
You pay the RMD tsunami, right? Because all of a sudden your tax rate goes up. You got to take all this money out. And so, by the way, it's a reason to have your retirement accounts perhaps managed one way and your post-tax money managed another thing and a good advisor would do for you. But yeah, I think if you're under age of 40, it's a no-brainer.
And another thing people forget,
do the Roth.
Another thing people forget is because remember, when you take money out of your IRA or your 401k, you're taking it out as ordinary income, which is generally, it is currently taxed at a potentially dramatically higher rate than ordinary
than your
capital gains rate.
Yeah,
and so for a lot of people, it actually, even if you can't do a Roth, it just makes sense to get a tax-managed mutual fund, a tax-managed growth fund, because they try not to distribute capital gains along the way, and they accrue capital gains, which becomes, in essence, a form of tax deferral. And when you take it out of those accounts, you only pay tax at the capital gains rate.
Yeah, no, I think that's an important thing to consider, that you do always have another partner when it comes to investing, and that is the government. And I'm going to be very interested to see all those young people that have been trading all those stocks and making so much money this year, what their tax bill will be at the end of 2020.
Oh,
that will be an interesting day.
Speaking of
short-term capital gains,
did you see
regular income tax rates?
Did you see what the IRS is adding on next year's 1040? A little box that said, "Have you ever received or used cryptocurrency for any purpose whatsoever?"
I did see that. They're going to try to trap you
because
into
if you say no, and you've done anything with crypto, anything,
Bye-bye.
Every time you buy something with crypto, you created a taxable event.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcaster show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's VESTORY.com, or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Just remember, 2020 will eventually end, and the election will eventually end.
The show will eventually end. I'm sorry, that was too easy. That's the way it's gone today.
It's almost over. We'll try again next week.
Return to my bed and my big bookie, and have a nice afternoon.
My big bookie.
I love that book.
You're sleeping with your bookie?
It's heavy enough too.
Book, not bookie.
Pardon me. All right. Sleeping with my bookie. Wait a minute now. That's because I couldn't cover the stuff I bet last week.
Apparently not. He knows
where we're at.
But here's
here.
the thing. Tom does know the difference between investing and gambling.
Yeah, that's true.
As does his bookie. 855-935-TALK is our number. Shh, be quiet. I've got a caller waiting. Right. Tom, welcome to Talking Real Money.
Hi, Tom.
Hey, guys. How are you?
Good.
Well, I guess we're okay.
Yeah.
Hey, I've got a quick question for you. I live in Edmonds, and I just bought a house in Walla Walla that we're going to retire to. So when I sell my house in Edmonds, I'm going to walk away with about $300,000. Now, I can take that $300,000 and I can invest it, or I can pay off the mortgage in Walla Walla and go into my retirement with no mortgage. And
too easy. This is too
easy. What's the interest rate on your Walla Walla mortgage?
What's the interest rate on your mortgage in Walla Walla?
I can make more than 4% on that $300 if I invest it. No.
Right. That's, hey, but wait.
Why are you paying 3%?
No,
4%.
4. Why are you paying 4?
Why are you paying 4?
Well, that's what it was when I bought the house.
Well, go get a new mortgage.
You can go get a 15-year for 2.5 or 30-year for 2.7. That's number one. Number two, but you start to get to 4 or 5, and then I start to wonder if you really can make more on the money, because we talked about this earlier, pension funds have made less than 4 over the long haul. Any rate, yes, your thinking is correct. And wow, enjoy Walla Walla.
Yeah, but I got to tell you,
changed dramatically since I was there.
If you stick with the 4% mortgage, then really Tom is right. It's not. You can't easily beat that. It may seem like it, but we don't know this for a fact, but there are reasons to believe that the rates of return in the future, because of the low bond yields and low interest rates across the board, are going to be lower. So get that mortgage down. There are so many great mortgage deals out there.
The other thing about being in retirement is you want to stay more liquid. That's another reason not to pay off a mortgage, because you need cash to pay the bills. So your thinking is right here. But yes, refinance and then invest the money somewhat moderately if you're going to need it in a period of time. That'd be the other thing to think about. And
I got to tell you, I did a lot of mortgage shopping when I refinanced a mortgage.
I saw you in the lane over there at Costco, yeah.
Well, and no, funny, you should say that. That's where I ended up getting the best deal.
That's where I got mine.
Because Costco cuts deals with these guys.
I know.
To put their closing costs at next to nothing.
No, the deals are
great.
It's
the closing costs that really eat up the difference, the spread between your current rate and the new rate. So if you're getting into a 15-year, and think about it, a 15-year and you're retiring, then you do have the option. You may very well pay off your mortgage before you pass away. So it's worth looking into.
What about this Fannie and Freddie thing where they're adding the 0.5%?
Who are these people again? They're a couple somewhere? Fannie and
Freddie. Yeah. They're going to drop by later to fix this show.
I got to tell you,
it's weird.
It is weird, and the market is so competitive right now that non-government backed paper is you're getting as good a deals as you are on some of the government backed stuff with less trouble sometimes on conventionals.
Think in 10 or 15 years, people will look back and say 2020 was a lousy year, but I got a 30-year mortgage for 2.7%. That's very inexpensive money. It's very inexpensive.
It's the lowest
historically.
It's the lowest in history.
Yeah, I mean, so there will be one thing that you'll be happy about, but
I'm happy
if you can get the mortgage. But another thing, if you can get the mortgage, because they are tightening.
The qualifications are a lot tougher. Yes, there are no more liar loans. You can't just imply income or lie about it. They do really check your credit. They really do check your ratios. They really do check your employment and your income streams. And so you got to jump through more hoops. But boy, is it worth it. Because I got to tell you, there is no way. My wife and I both thought about paying off our retirement home mortgage. But the more we looked at it, the more we went, 2 3/4 versus, and we got our 15-year a little before you in the
You got to get up there
rate.
Because Nurse Ratchet's still waiting at your retirement home to help you, isn't she?
Yeah, it's a retirement house. It's the house.
You called it retirement home.
It's our home in which we'll
It's like
retire.
me waiting, like the bookie waiting for me at the, that was.
See, I told you.
On me, I'm going to come right back.
The Benadryl, if you take Benadryl at night, it affects
4 of those a
cognition.
Day. Exactly. Yes, I think this is, by the way, I still like the 5% rule. If you have an interest rate of above 5 and you have cash, then I think you should pay things off. If it's below 5, then you start getting into the, should I keep it? Should I invest it? I think that's fair. You raise a very good point. People believe, they still do after all this time, that I can make 8 to 10% a year on my money investing in stocks. There's very few people that actually make that.
I believe
very few.
I believe you can, if you have 100% equity portfolio, globally diversified, I still believe that an 8 to 10% return is entirely within the realm of reason, but boy, is it going to take a strong stomach.
Well, let me rephrase that. There's very few people who have actually made that because you had to stay with it, because you got to keep your costs low, because all that noise is going to come at you. It's going to be out there, whatever next year's reasons why are to get out of the market. And we know history has shown very few people stick with it, have a plan, and say, it's okay because I know the market's going to go down, but it's going to come back.
And it requires all of you who believe that, well, I'm not going to go in those international markets because they've been down. It requires you be one of those who go into those international markets because they haven't done as well. It requires that you continue to overweight slightly to value because they haven't done as well, while you continue to own small companies because they haven't done as well. Tom tried to make this point earlier, and I think people just don't hear it. You want to buy those things that are on sale, not the ones that are overpriced.
It's very counterintuitive. We know very few people actually do it regularly. And if you don't have a discipline to it, it's even tough. In other words, like what we did for our clients this spring, when the bond funds that we had held, the largest one was up 10% and the stocks were down like 25%. You sold the bonds and bought the stocks. I know almost no do-it-yourselfers who did that because it's so incredibly counterintuitive. It makes you so nervous. Like, I don't want to sell the thing that's gone up. Why would I ever want to do that?
That may be the biggest reason to have an advisor, is that right there. Because the only way you're really likely, unless you're an incredibly disciplined human being, and come on, you're not. Really, most people are not. We're driven by our emotions. You actually need to, as the attorney said earlier, I need somebody who knows more about this than I do and is going to make me do what's best for me. Think of your financial advisor as your mom. She's going to make you do what's best for you.
Clean your room.
Eat
your peas.
Buy
and brush
your
your
international
teeth,
stocks, honey. Buy your international stocks.
Oh, thanks a lot, Mom. That really helps.
Remember, you can call us 24 hours a day and get your questions answered at 855-935-TALK or go to TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.